Okay. I think we can get started. People are all popping in rapid fire now. Hi everybody. Thank you for joining us today. This is our Empire Builders webinar series. We do this usually quarterly. So this is maybe the seventh or eighth one that we've done. For those of you who normally listen, thank you for joining again. And for everybody new, welcome. To start off, we typically just give, I think most of you are familiar with ApplePie, but in case you're not, I will give you a quick overview. At ApplePie, we are 100% franchise focused, so we only lend to franchise businesses. To date, we have done over $3 billion in loans across over 200 different brands. Our goal is not only to just understand your brand, but also your individual financing needs, whether you're on unit number one, unit number 25, or beyond. So one of the ways we do this is through our conventional Apple Pie loan. We have some unique options there to help accelerate your growth. And we also have a well-established network of SBA lenders and equipment lenders as well, so that we can look in several directions for the financing option that works best for you, depending on what point you are in your journey and what your financing goals are. So now that you know who Apple Pie is, I will introduce myself and our panelists for today. I'm Samantha Holt. I'm the director of sales at Apple Pie. I have been with the company since 2017, so almost 9 years now. Working in a handful of different roles. I was a relationship manager to start, and now I sort of oversee our sales team and the relationship managers who work on the individual loans for our franchisees. Our panelists today are Alicia Miller and Todd Recknagel. We are very excited to have both of them on today and grateful for their time. I know they're very busy individuals and have a wealth of knowledge to share. I'm going to let them introduce themselves and just give a short background, and then we'll sort of get into our topics. Alicia, would you like to start?
Sure. Alicia Miller, Emergent Growth Advisors. I advise founders on their first private equity transaction. I also work with private equity firms who are looking for acquisition opportunities. I wrote a book on the topic of PE's impact on the franchise sector called Big Money in Franchising. I also write for Franchise Times, a monthly column I've done, I think, for about 5 or 6 years now, on smart ways to grow your business. And I am an investor in franchising at both the franchisor and franchisee level. I'm very happy to be here and looking forward to your questions.
Amazing. Thank you, Alicia. Todd, what should we know about you?
Sure. Well, first, on Alicia, her book is fantastic. I highly recommend it. And there are actually several examples that Alicia uses in the book that are a couple of transactions that we've been involved with in our past. We helped grow Mr. Handyman and Service Brands, and that was one of our investments and involvement in the past, as well as Take Five Oil Change as we developed that model, and both those companies were successful transactions. I actually, it says CEO, largest Massage Envy franchisee group. We were serving as CEO 18 months ago. It's one of our portfolio companies. We have a fantastic CEO in Mark Dawson. He's actually the CEO of our group. So we're private equity and backers in the deal and partners in the deal. We also are the largest franchisee with Sola Salons with 60 units. So we've been involved with over 15 different franchisors and over 5 or 6 large multi-unit franchisees where we're the largest in some of the systems. And so we continue to invest in a number of different franchisor deals.
Amazing. Yeah, both of your credentials exceed the room that we have on this slide. So it's good that we were, we were able to elaborate a little bit. I appreciate that.
Sure.
So obviously, as both of you mentioned, and as we all know, private equity has become increasingly common in franchising, especially as of late among larger franchisees looking to grow faster or scale more efficiently. And I think it's often talked about at the brand level, but I think franchisees feel its impact as well in a number of ways. And so we thought this topic would be valuable to just better understand how private equity works and how it fits into the world of franchising. Um, I guess starting off really basic because we have a broad audience. What is private equity and why is franchising an attractive business model for private equity investors? I guess either
Well,
of you could
I'm
be
gonna
the
I'm gonna give
expert
that
there.
to Alicia because she wrote the book on the private equity.
Literally.
So, sure, private equity is has lots of different categories in it. So not all private equity firms are the same. That's important to understand. Traditional private equity takes money from investors and puts it in a pool and invests it in buying businesses, growing them, and selling them. That's what they do. We loosely refer to firms as private equity uh, throughout the whole ecosystem, but there's also family offices. There are independent sponsors who need to go out and raise money before they can invest in a business. There are large franchisees who go out and invest in businesses as equity holders. So there's lots of different flavors of private equity. Traditional private equity firms, the ones who go and raise money and put it in a pool and invest in companies, more than 250 of them have participated in franchising since the 1990s, and they've invested in close to 800 franchise brands at this point. So it's very, very active, and they invest at both the franchisor level and the franchisee level.
Yeah. And so I would just elaborate on that private equity by definition can be a group of partners, just as Alicia said, like family offices. And that was kind of even much like how Service Brands was back in the day, where it was multiple individual partners. But there's been a real growth we've seen over the last 25 years of the expansion of private equity in franchising. And oftentimes, that's a little bit where we come in. We have made a good portion of our wealth in franchising and have been in multiple systems. And so almost every deal we're in, we kind of call it the smaller check. And then there's a fund that has the bigger check. Where they'll come in and we partner together to do a deal, and then we would stand as an operating partner and kind of the interface, understanding franchising and all the levers and the ways that you can grow a company. So it's good to have it's if you're going to have a private equity deal, it's good to have franchise expertise or experience in that deal. So, and as Alicia said, the 800 different franchise firms, you can imagine there's just a proliferation of a lot of private equity firms that maybe don't have that experience that are coming into franchising.
Absolutely. Yeah, I do want to talk more at some point about the most common, something that you touched on and some of the more common investment structures that occur. But before we go into that, and this might be obvious for a lot of listeners, but in case it's not, why is the franchise business model so attractive for private equity investors? And also, what are some common red flags that could stop the interest in some cases?
Well, let's start with why they like it first and exhaust that topic, and then we'll go over to red flags just so we don't mix
Sure.
metaphors here. Why
Mhm.
it's attractive? Franchising's been around for more than a century, so it is a proven business model and a proven way to expand units using someone else's capital, and many times it creates a recurring revenue model as well. So some franchises are more transactional and some are more recurring revenue, depending on the model. But private equity firms like the model, and especially when it hits scale, franchise businesses can throw off an awful lot of cash for really comparatively low capital investment on their part. Provided there's good unit level economics and a good franchisor franchisee relationship, the thing just can continue to grow and blossom over time. And there's also now quite a lot of evidence that if you do all the right things and grow that franchise business, that private equity sponsor knows there'll be a buyer later on, which is always helpful, and that they can probably make good money on the exit. So all those things have lined up to encourage private equity to come in mass at this point, and it's really they're really quite active in franchising as a reason.
Yeah. And then I would just add on to that that royalty structure that a franchisor has, oftentimes just with that growth that Alicia had mentioned, most systems, it's a very predictable royalty structure. So coming in and buying the intellectual property of a franchise system is very predictable cash flows. Then what that means is that's very bankable. And so if a private equity firm can come in and let's say it's $100 million deal and they can do a $50 million bank and 50 million equity check, it becomes a very predictable cash flow that you can still grow because you know how to grow the brand, you know how to add more units, yeah, but it certainly likely is not going to go down. So it takes a lot of the risk out, and and kind of taking the risk out for a bank or private equity is kind of the name of the game.
It also is because there are very clear levers that are you can pull across all sorts of different categories of franchising that are very similar that private equity can get behind and say, okay, we can help the brand do that. So, for example, they can invest in adding to the team and adding talent on the team. They can invest in franchise growth through franchise development. They can help on supply chain issues. They can add investment in the tech stack and other things that will help grow the business. So there's actionable things that they can go and do to improve the business. And then that combined with just adding units, as Todd said, is a really kind of a lower risk way to grow a business and invest. And once a firm gets really good at the franchise business model, they can then, there's a lot of franchises they can choose from, so they can get some scale economies that way as well.
Yeah. And by
Absolutely.
the way, just for the listeners too, private equity is really all of us in many ways. Sometimes it gets a bad name, but private equity, the funds are funded by endowments, insurance companies, 401k retirements that get rolled over. And so there's a little piece of a lot of different funds that end up going into a lot of the very well-known private equity funds. And so it's that 5 to 10% risk piece that is part of any endowment or any insurance company or any large scale investment that goes into private equity. And so oftentimes it's our own 401ks, if you will, that are invested in those and then come back into franchising. So
Sure. This actually might, I know we went down the path of, why do you want to get involved and maybe why wouldn't you? But I think this question might answer some of that sort of anecdotally, because what I'm curious about is, Alicia, you said, especially when they start to scale, and you sort of alluded to when it makes sense for private equity to get involved, both at either the franchisor level and the franchisee level. And I think a lot of people are curious about what key points in either of those life cycles does it typically make sense for private equity to show up, and maybe when is it like either too soon or not a good point in time. Can you speak to that a little bit?
Sure, and we also need to circle back on the red flags as
Yeah,
well.
right. Yeah.
So franchise brands go through some fairly predictable life cycle steps as they go. Small emerging brands, they may often be too small for a private equity firm to purchase. Excuse me. So there's definitely a timing issue early on. Um, Private equity firms cannot write small checks, which is a good problem to have.
Mhm.
So very often, an emerging brand may want help, but is literally too small to be able to attract private equity investment. That's partly why multi-brand platforms have proliferated because it somewhat solves that problem for the PE firm. They can bolt on, they can start with maybe a large anchor acquisition, and then they can add smaller companies to the platform and sort of get over the fact that they're just not that big. But then you'll see these very common inflection points as brands get bigger. The business gets more complicated. They start facing more competition. The founding team may not have the knowledge or skills to get it to the next level, and that's usually a a common place for an investor to come in. And that initial investor might be really good at working with emerging brands, but then exits later to a larger firm that's expertise is more driving scale. And then yet another firm upstream might be really good at taking a brand international, for example, or adding more brands to a platform. So you'll see kind of very predictable points along the way where you got to change horses and leadership's got to change and to take the brand to the next place. But one thing is for certain, once a brand is on that PE profit ladder with that first acquisition, it's very likely to then trade to another private equity firm. That's just what happens.
Yeah. And in terms of like size and scale that Alicia alluded to, kind of a sweet spot target is sort of between that 2 million of EBITDA and 10 million. And that's kind of what they're looking for. But it's interesting that it's a little bit out of scale for many emerging franchisors because it takes, you need to almost have 50 to 100 units that are starting to mature, that are paying enough royalty to get a franchise brand to royalty self-sufficiency to actually achieve that 2 million to meet the bottom of the scale, if you will. Now, you do have some that have company-owned units and some of the profits are flowing through and they might have 5 million. We look at deals all the time that are smaller, but making surprisingly good money. But usually that's the exception, not the rule. In fact, it's a very, very high percentage, 90, 95%, something like that, that never make 100 units of a franchise system. And so oftentimes some of the emerging franchisors are just off the small end of where a private equity firm really wants to go. And so a little bit of the solve for that, as Alicia said, is the platform, until they grow. And then sometimes some of the red flags that, some of the franchise systems, they'll sell a lot of units, but they haven't gotten them open. And so they call them SNOs, sold but not open yet. And so that becomes a little tough because operationally it's expensive to get that distribution and to get them all open. And so we kind of see systems that get out over their skis on having SNOs on their books.
Yeah, makes a lot of sense.
And buyers are getting more choosy. The space is pretty picked over at this point. So some of the bigger businesses have had plenty of opportunities to bring in a PE partner if they want one. Um, so there have been private equity firms have been forced to look at smaller and smaller deals just to have enough to work on. But this sold not open issue, they're getting pickier about it because they've been burned. And some of these smaller brands have been kind of a big lift, bigger than they expected and more expensive to lift. So when they're looking at your sold not open funnel, they're going to want to see a good chunk of franchisees who've got at least a year of operating experience before they're probably going to get that serious about your brand. So if you've got 100 sold and only three have a year of experience, no one's going to be really that interested probably in talking to you.
Right.
And you're just going to have to kind of wait it out. So you've got to make sure you've got enough cash so that you can survive and get those units open and profitable. They also want to make sure you know what you're doing with recruiting. You could have recruited 100 of the wrong people. So that's got to have time to play itself out. And if you haven't set up your structure so that you can survive on your own without help to get you over that hump, you're going to get stuck. And that's one of the red flags that they're frankly are looking for.
We also see sometimes we want to know the makeup of that 100. So if it's 30 franchisees that all bought a 3-pack,
Yeah.
and just simply by definition, all of those franchisees are waiting, as Alicia said, for their own profitability to open unit 2 and open unit 3. And they've got it planned out for the next 4 years. But the franchisor is saying, oh, hey, we're expecting them all to be open within the next 6 to 18 months. And it simply might be unrealistic. And so a lot of the PE firms are very, very quick on the uptake. You got guys that are, young men and women that are staying up all night crunching crunching data, and they figure that stuff out real quick. They're a lot smarter than I am, and they get to the real answers right now. So you do have to be careful of that for sure.
As a franchisor, as a founder, you've got to be also careful about your own expectations. Bankers can puff you up and say, "Oh yeah, you'll get paid on that." They call it embedded value. What it just means is that hasn't materialized yet. So you may not get paid on sold not open funnel because you haven't proven that it's real. The more
Sure.
you can prove it's real, document the progress you're making, getting people open, the more likely that you might get paid on that if you decide to sell, earlier. So
Yeah,
beware.
absolutely. What about for the franchisees listening, if they're at a point where they're considering taking on private equity investors, what do you think is important that they understand, and what considerations should they be making to tell if it's a good option for them?
Sure. Well, I can kind of speak to our experience a little bit with a few of the deals we've done. Um, we always kind of go and look to try to understand the brand first, talking to lots of franchisees and do our due diligence before we got in. So, for example, even if you take one of the brands that we're in right now, we kind of called it a little bit of a beachhead where we bought a number of units in one area and then bought units in another area. And we wanted to see if the management could be treated like the owner, if we could build the platforms so that our management would have all the incentives that we would build in, and then would we have the data, and would the system work like that so that they could be kind of essentially the franchisee in our place and then succeed with that unit. And would that unit economics bear all those costs and would it make sense? So we found that out over the next year or two after we got in, did our due diligence, purchased those units and built a group. And in growing that, we doubled the earnings of that group and said, hey, this has scale. At the same time, we were meeting other owners and we were looking at the timing of the franchise agreements. It was a system that had 10, 15 years of maturity. So a lot of agreements were coming due, folks that might have been 50 when they got in or 65. So we knew we could start pulling other units together. And so when we got to 28 units, we were able to pull in private equity. So it first started out with our family office, kind of having that beachhead, if you will. Then we pulled in private equity. And we like that because we can work with we work with two or three different private equity firms that we know and love and trust. And so we know we could be minority while they're majority, but we're lockstep together. We're looking for the same thing. And then that was one of the groups that we grew from 28 to 130. So, uh, so your original question is if somebody's looking to scale, one of the things I did very simply was I started to share with a couple of my PE friends. I shared my numbers quarterly. I was sending them to them for a couple years and just showing them our operational, how we would take over stuff, how we'd grow it, what it would look like, so that they could see behind the scenes the value and the scale and the growth, the operational growth. Because if you can start growing units and if you can grow them organically through improving operations and then grow them geometrically as well because you're acquiring EBITDA, you have a perfect formula where you're buying a certain amount of EBITDA, but then you're improving it organically. And then that's essentially how we've been able to scale. But you've got to build in a couple of partners that, you know, want to know your business, as you're growing. And you got to be committed too, obviously. I mean, if most of the franchisees that are on the phone, I'm sure they're committed to the brand they're in.
Mhm.
But you have to have a little bit of a plan in the background to do that.
Right. Anything to add, Alicia?
So he's right that creating a really solid operating platform is what you are ultimately marketing to a potential PE investor, no matter what size you're at. But there's sort of a critical mass you have to get to create that team. The next buyer upstream is not going to want to invest in a platform that needs a lot of fixing. They want to make sure that you are an absolute operating machine, best in class, that you are operating in the top group in that franchise system, and therefore you get the best opportunities for acquisitions. And you can also even take on businesses that need work that are underperforming, and you have proven you can turn them into higher performing businesses. That's got legs, and they can invest in that and continue to grow. And obviously, the system itself's got to be big enough so that they can see there's still white space to then go make more acquisitions. Some other things to think about is as private equity has come in at the unit level, franchisors have got to contend with, okay, what does that mean for the system? And many of them have added restrictions on the type of owners they'll let into the system. And, a private equity firm's not going to sign a personal guarantee. So they've got to sort through that. Some of them have put restrictions on how big that franchise group can get, which means there's a ceiling to where the next buyer could potentially get them, which might make it less attractive of a business. There could be restrictions on what other brands that platform could own. So you've got to really understand how that franchisor itself thinks about private equity, because if you're targeting a private equity exit yourself as a franchisee, then you've got to really familiarize yourself with the thinking on the management team behind that and what the contract says is permitted, and know that it can change because that franchisor might itself trade
Mhm.
5 years from now, and now there's a new sheriff in town, and they may add language to the agreement that the next group coming in would have to deal with. So I don't know, Todd, if you want to comment on that
Oh
angle.
yeah, no, it's spot on. As we've continued to grow and scale, our group is doing very well, and EBIT is very strong, and our leverage is very low. But we've had franchise systems in our past that have said, "Oh, hey, we want a restriction on your borrowing," for example. They want the franchisee to sign an agreement that they might not even be willing to sign. So meanwhile, as Alicia said, the franchisor might trade, and they might stack up the franchisor with a bunch of debt on the new trade, and then they have less resources available to take care of the franchisee. And then as a big multi-unit, we end up having to build our own systems or do our own stuff. And so we're large enough that it becomes a bit of a concern on that side. Now, our systems, we've been able to get along great with everybody and continue to grow, and life is good. But I see this all the time uh, where there almost needs to be some protections of the franchisor, not over levering and getting into the nosebleed multiples on the next trade because it really affects the franchisees. So that's always a little bit of a concern. Uh, now that Alicia has mentioned it, it's a concern. No, I'm just kidding.
Hadn't thought
Now I'm
about
worried. I'm gonna have to worry all afternoon now. No,
that.
one thing I wanted to go back to though, given that we probably have a lot of franchisees on the call that would like to scale, when we were smaller or in any of the systems where we were all smaller or started out smaller, we tried to do our best to duplicate the systems that you might have at scale, even when we're small. So what do I mean by that? We were very, very quick to put all our leases and all of our stuff into either LeaseCake, which is a great platform to track all your leases, and it's reasonable monthly per lease. So you can scale upward with that. LeaseCake was really great. We went and put our stuff in a cloud platform so that we had all of our data in one place so our managers could access it, and we could see, had all our incentives built in place so that they knew we were on accounting platforms. They had the information at the same time I had the information. So I could treat them like my new franchisees that were the manager and the owner operator of each location. And so we did a lot of that stuff where we outsourced that. Now, today, in any of our companies, we have a full C-suite and CFO and do our own accounting and payroll. But we outsourced all of that stuff and made it very scalable. And so then when we came to do a merger or when we came to expand or bring on a PE check, The data was right there in the cloud. We had a data room already set up. We had, all the stuff was outsourced. I could just show them our systems and print off stuff, have instant information, on
Mhm.
the deal. So I do think you kind of want to act like private equity. If you're a operator that wants to scale as a multi-unit, act like private equity early on. You can outsource all of that stuff. And at the end of the day, it makes you very, very professional.
Yeah. I mean, that's important for a number of reasons, but especially in this context.
I think
Great.
the expectations are accelerating in terms of what buyers want to see from multi-unit operators. In an environment today where we have so many AI tools that are getting better and better and better at recommending things you could do differently to grow your business, to manage field operations, to analyze the data you're getting from your units. If you're not really fully engaged in that, you're just going to look kind of backwards and tired. And I don't care if you've got 2 units or 200 units, you really need to get yourself immersed in some of the newer AI tools and understand what you can use to look so buttoned up when you start talking to potential investors, because their expectations are getting more higher and higher.
Really great advice. Um, we touched on this a little bit at various points, but can you describe and elaborate, I guess, on the most common investment structures that occur in private equity, whether it's a platform investment or direct purchase versus taking majority or minority stakes, and maybe an example of when one is a better option than the other.
Most traditional private equity firms have to have majority control. That's in their fund documentation. So majority deals are much, much more common than minority deals. There are a few players out there, and also family offices and others who have more flexible capital structures who might be willing to do minority. But
Mhm.
even in those minority deals, there are hooks in those agreements that allow them to assert themselves in the business. So just because they're a minority doesn't mean that they are passive, and that's a consideration for you.
Yeah. But it's actually a great step to take for a couple of reasons. One, there might be a lot of franchise founders that they're running the franchise, they're growing the brand, they're continuing to add franchisees, they've got great relationships with their franchisees. And having a minority, there are funds that do that, or family offices, or our firm, for example, will come in as a minority partner. But it helps bring a little bit of that discipline and prepares you for the next step, oftentimes. And so, bringing on a minority partner early on, even though there's some of those controls, as Alicia said, and usually those controls are around compensation, you pay yourself, distributions, going out borrowing, doing a lot of the things that you're altering the balance sheet of the company or paying out excessive amounts. Usually it has to be agreed upon with the minority partners where most of those rules and guidelines lie. But bringing a minority partner on can help you prep for that next stage, help you continue to grow, take a little bit of some chips off the table, and then prep for for a bigger sale potentially later. Um, that oftentimes when that bigger sale comes, they expect the minority partner and the majority, say, founder, they usually expect them to roll over some amount, 10, 20%, in the future deal. And so you might have chips off the table early, then you might have another big round, then you might still have another, third bite at the apple. And oftentimes as the enterprise grow, um, there's plenty of money available for everybody as long as you're all heading up and to the right. Um, so I hope that answered your question on how they're structured sometimes as a majority and minority. But
Definitely. Yes, thank you for elaborating. What about financing options and how lenders are evaluating PE-backed businesses? Do either of you have a lot of insight into that, or what has your experience been?
we actually we have financed and refinanced a number of them, and the terms are actually getting better right now. We had several very, very positive outcomes where rate went down a little bit, flexibility went up, and we're usually pretty aggressive in our, debt pay down. And so a good lender wants to keep good money out to a good credit, right? And grow with you. Um, and so we've actually seen the market improve. Um, Oftentimes they're floating rates. And so um, the expectation is that interest rates would drift lower, I guess, in the next year. So the rate may get better, but we've seen better margins on the rates and more flexibility with financing. So financing hasn't been a real problem this year that we've seen. But I don't know, Alicia, maybe you're seeing a lot of stuff across the waterfront too.
Um, you run a high quality business and are well respected, so it's not a surprise that you don't run into trouble getting lenders who take you seriously and give you money to expand because you are very proven. I think there are a lot of brands and platforms that underestimate lenders until it becomes a problem. In particular, brands that have a um, low initial investment. So if you're going to build a daycare center or a swim school, you've got to go out and get a lot of SBA funding if you're a franchisee potentially. Those kinds of brands tend to take the lender community much more seriously and bake into their Fran Dev process, working with lenders, educating them about their brand, and presenting strong data to the lender community that then wins lender support so franchisees can go get the loans. Brands that are, especially like home services brands where it's just you just need a truck to get started. People are not going and getting an SBA loan because they don't need that much money. They often will make the mistake of not really caring about what the lender community thinks of them and not especially caring if there's turnover. They say, well, we recruited the wrong franchisee. We need to put that territory in the hands of a better performer. The problem is that the lenders are watching this churn, and then later on, at some point, you're going to need consolidators in your system who are strong operators who can help deal with underperforming territories. And if you make it to this stage, you're going to need some sort of a resale program. Well, now you're buying a chunkier asset or set of assets, and that buyer might need an SBA loan at that point, but you haven't bothered to um, work with lenders because you hadn't needed them up to that point, and now you need them. So now the lenders are going to look at your history and go, "Wow, what's your historical unit level performance? What's your turnover? How credit worthy is the franchisor itself? Do you have enough cash to survive, or are you not quite at profitability, or just over?" So some of those hygiene things as a brand that you need to do to protect your reputation with the lender community, I encourage you to do that work early. I moonlight with Fran Data. That's a great organization to connect with to help you navigate that process so that you don't end up later trying to consolidate and not having the support of the lender community
Yeah.
behind you
Yeah,
to
and
do that.
I couldn't agree more. I know even way back in the day with Randy Jones, and I know he's partnered in with ApplePie Capital, and they've always been great. We always stayed close with our models at Service Brands, even where we would launch them, and we wanted the big lenders to fully understand what we were doing. And so over the years, I've stayed close to Ron Feldman, and we would talk deals back and forth. And so just like I was saying, sharing your numbers with the private equity side, it's really important to have those relationships. You want to have all those strong relationships with the lenders before you need the money, right?
Yeah,
If you intend to expand.
absolutely. Excellent advice. Thank you. Um, Shifting gears a little bit, we have a handful of questions, but I think we'll still have time to answer them if we get into one or two more, because we've got about 20 minutes left. Um,
Great.
Alicia, one of the key learnings in your book, it talks about private equity's growth playbook to accelerate brands. And I thought that was interesting. And can you elaborate a little bit on that and talk about maybe one specific thing that you've seen done really well?
So private equity has a very clear playbook on how to accelerate franchise businesses. It's ideal if you can buy yourself additional time and go run some of those plays yourself before you bring in a PE partner so that you're more mature and you're larger and you've got more profitability before you go and find a PE partner because then you will get more value from it.
Mhm.
But you can borrow their playbook. It's just a question of what can you execute yourself and where do you really need help. Where private equity has been probably most active is tech stack, really improving field and operational support to shore up sustainability of the system and make sure every opening happens on time and franchisees ramp to profitability in, a clear path and quickly and on franchise development. Fran Dev recently has become really challenging for many emerging brands because PE-backed platforms have kind of taken over the space along with broker networks. And there's a lot of noise and it's hard for smaller brands to be heard. But it's very easy for a PE platform to throw money at the broker networks and sign more deals. And look, if you're running a platform with 10 brands and then you're running another platform with 10 brands and all of those brands are in the broker network, it's hard for any other brand in those same categories to be seen because that broker network does not want to lose that all of those brands. So that playbook is being run over and over and over and over. I think, which is why we're seeing more smaller brands today wanting to get help earlier because they sort of have to. If you're not well enough capitalized, you're going to run into trouble
Right.
on that growth piece.
Right. Yeah, it makes perfect sense. Todd, anything to add? I know you didn't write this book, but I feel like you might have something to add.
No, I was thinking a little bit about Alicia was talking about scaling the franchisors and some of those platforms, and I was thinking a little bit about the franchisee side that some folks may not understand. You can have 3 or 4 units or 5 units, and let's say their four-wall EBITDA is throwing off 200,000 a unit. So they're $1 million a year. They've got a nice company, nice lifestyle. Um, that might be to an investor, that might be only 3 to 5 times multiple on that EBITDA for a couple of reasons. That's the four-wall EBITDA. They don't necessarily have that platform that Alicia was talking about as a multi-unit operator. They're certainly maybe not multi-branded. So there's a limit on the value of what you'd have on that because you got to go build all of that. And so meanwhile, if you put several of those together and then build that overhead structure, so call it 4 of those owners that maybe are 15 or 20 units that all of a sudden now there's 4 million of four-wall EBITDA and you've got a management team for 750,000 or whatever. Now all of a sudden you're getting up over the 3 million and you could probably, pretty safely look at 5 to 6 times. So you have a little bit of a EBITDA expansion, but then you also have what's called the multiple expansion. And so when you do the math on that, you have a higher enterprise value. If you start from that kind of a base and you get to 5 million of EBITDA, there's another trigger point where the market's probably, we just actually had some presentations the last 3 days. I was in board meetings, and I think the market right now is something like 6.6 to 7.8 times, kind of in that range when you're over the 5 million of EBITDA. Then if you crisscross the 10 million, it's different again, and you get closer to the 8 or 9. And so that multiple expansion is a little bit why you see multi-unit operators continue to grow, because if I have units across 12 states in the country and they're in different markets and they're all operationally doing well, there's pretty good stability of earnings. They know that you've got a lot of room and runway at 10 million. So a buyer knows that and they're willing to pay more. So I just kind of wanted to kind of lay out a little bit of that scalability on the multi-unit side, what that looks like, and why there's a little bit more value at the top.
Yeah, very helpful example. Thank you, Todd. Um, I think both of you might have comments on this. How do you see the role of private equity evolving in the franchise sector, let's say in the next 5 to 10 years?
I think private equity will need to, I don't know if they recognize it yet, but I think they will need to get engaged in government relations and protecting the franchise model more directly than they traditionally have been. There's still a lot of headwinds for franchising, and traditionally they've been sort of hands off and have allowed the brands to participate or multi-unit franchisees. But private equity firms um, have lifted a lot of brands and are very well entrenched in franchising at this point. And for them to be hands off when it comes to that critical piece of franchising is a little puzzling.
Mhm.
I think they need to be more directly engaged. Some are, but compared to the totality of the investors in the community that are engaged, I would say they've got some work to do. So that's one thing I see maybe changing in the next 5 years.
Yeah,
That's a
completely agree.
suggestion. Do you think that will happen? Because I think that influence is important. What do you think that, do you see it actually happening or
No,
you?
I think it's an area of opportunity, and partly it's a communication and relationship issue where we just all need to maybe be more open about talking about that need and that,
Mhm.
Yeah.
but the private equity industry outside of franchising, I think, has been successful engaging in those issues and allowing government to understand how private capital is a critical underpinning of our entire economy. It's just that franchise piece that gap needs to be closed.
Makes sense.
Yeah. And that almost looks bigger in the current year because of the American Franchise Act. And
Mhm.
so because of AFA this year, if private equity is owning lots of units or franchisors, it is very important, I think, for them to get involved. Um, I think in general, private equity is going to continue to grow in this space. We see it all the time. We get constantly approached by more and more firms. You see bigger and bigger deals. You see stuff like Jersey Mike's trading. So you see some of the biggest firms in the world like KKR owning Neighborly or Blackstone buying Jersey Mike's and so a lot of that brings kind of eye-popping headline and news, and then I think you'll see that continue to have tailwinds. You'll see it go wider. You also see private equity talking about lots and lots of dry powder out there. There's more money that has been raised in private equity than ever before in the history of the world. And so there is a lot of dry powder out there. So it's sort of like, well, why wouldn't there be continued strong investment in franchising? The
Sure.
the downside of that as a multi-unit franchisee and franchisor is I worry when there's too many dollars sometimes chasing reality, stuff gets bid up, and so you end up having higher and higher multiples. And then I'm not sure if the growth always sustains with that. So people get burned in markets when they overpay. And so
Mhm.
I'm not saying anyone's overpaying in any one deal because they all love their own deal and they're brilliant, right? But the fear, the risk is that the pendulum swings the other way and that some of these deals, could be kind of, overpaid. And you don't want to see anybody lose money. You don't want to see franchisees get hurt. You don't want to see systems go bankrupt.
Sure.
So, um, so that would be the fear on that side. But you'll have continued growth in private equity for sure.
And we'll
Right.
have continued new entrants. I worry that there are continued new entrants who don't have franchise experience, who may end up buying assets that more experienced franchise investors passed on. And
Right.
lifting a franchise business that needs work is one of the hardest assignments in business. And my hope is that if those investors are new to franchising, that they are really investing in the help and expertise that they need to help them lift those businesses because I just worry that they don't necessarily know what they're doing if they don't have the right operating partners and advisors who have a deeper franchise experience than they do.
Yeah.
Yeah, that's interesting. We actually, well, we could talk for probably a whole other hour or two, but you just touched on one of the questions. We're kind of in the Q&A time frame, so I might start asking. There's a handful of them. One of the questions in the chat is, do you optimize and sell off underperforming units?
I assume
Um,
is that a franchisor or a franchisee who's asking that question?
Uh, I'm going to assume it's a franchisee, but that's an assumption.
yeah. Um, well, this this goes back to the 90s when I had restaurants and was the largest franchisee in a system in the 90s. And when we first started, we had three or four, and I had a couple units that I was dividing my time. I had not figured out how to duplicate my time and get all the incentives in place and all that. So I'm running around in these three or four units, two making money, two losing money. And I had the father of one of my employees come and say, "Oh, hey, I know it's kind of slow here. Allison said things weren't great. I wouldn't mind buying it and stuff." And he was offering me about half what I had in it. And I thought about taking it. And I had just a sleepless night that night. And I thought, yeah, I'm kind of giving up, but is it ego? And what am I doing? And maybe I can't handle all these. And, I'm dividing myself. And the next day I woke up and I just had just a fresh answer that's always been true ever since. This is 30 years ago. And I was like, I have to fix this unit, whether I keep it or sell it. I'm not gonna I'm not gonna sell it for half price. I need to be the one to fit. And that was the day I really owned that unit. Not not when I not when I built it, not when I signed the franchise agreement, when the day I was like, oh my gosh. And so I dug in, got hands-on, was all over it. We brought in an operations manager, we brought in the right people, we figured it out. We grew all those units into profitability and they did fabulously well. But I came so close to dumping a unit. And it was a little bit of that excuse to myself. I was lying to myself a little bit that, well, maybe it's a bad site. No, it wasn't. I just I just needed to do all the blocking and tackling to grow each one of those units. And so anytime I've had a franchisee come to me ever since, I've said, hey, you just need to get in there and just see what's wrong. Go hands on at that unit. And then you'll know. Then you'll feel a lot better. You'll feel a lot better later. So.
Sure. Very good advice. Um, Another question that came through the chat was, what AI tools would you recommend to look at for franchisees to use to make themselves a good business for private equity?
Go ahead, Todd.
We're looking at a lot of AI tools right now. And our general philosophy is AI is not going to replace the human, frankly. In fact, people get, a little irritated when, everyone on this call has probably been in a endless phone loop where they're like, oh my God, you just can't get anywhere. So we think that AI can help improve the productivity to have the human perform a lot better. And so if something is getting an answer more quickly or checking somebody in automatically, or if a phone call is coming in and it's properly routed now better with AI, and getting that answered. There's a lot of repeated tasks that can kind of come up to the surface so the human can perform better. So there's going to be a lot of efficiencies coming through with AI, but we don't think it ever, fully replaces the human. So we're looking at lots of stuff on the call center side. We're looking at lots of stuff on booking. We're looking at a lot of those repeat tasks, and we're going deeper in all our companies actually right now. It's pretty phenomenal, actually, but we're not um, we're digging in, and I generally believe you don't have to flip your whole technology stack and be out 2 years. You just need to kind of be 15 minutes ahead of the next guy. Doesn't have to be 2 years. If you can continue to stay up on stuff and improve your systems, and as the AI gets better, I think it'll help you improve your efficiencies. That's kind of how we look at AI. I don't know if that answered that question or not, but
I would add also, um, think about where the friction points are in your business and if there are ways for AI tools to help reduce that friction. And are there areas where documentation and data is just weighing you down as opposed to empowering you to run a better business? Because ideally, that's a great place for AI to give you more information, which then humans can go out and execute. I agree with Todd. It's not going to replace humans. So a tool to recommend for, say, operations would be Harmonize, which is a new platform where they're taking all of your operating data and all of the various inputs of the levers and KPIs that your particular business is founded on, and then it spits out to your field operations team, okay, here's what you need to do today to move this business forward. So it's taking friction out. It's taking so they don't have to sit in front of a computer and analyze, okay, what should I do with my franchisees today, or what recommendations should I make?
Mhm.
The AI engine makes the recommendation, and then now you've got something to talk about to say, okay, well, do we agree with these recommendations? Now let's go run the plays and try to move the business forward today. So I think that's where we're going to see increased profitability, hopefully for franchisees and the system as those tools kind of speed up that data crunch that everyone is stuck in. We're just trying to figure out what to do. What is the data telling them?
Keeps the human there, but makes the human more efficient. Excellent. Well, listen, we are ironically we're almost right on time. This almost never happens. Although, like I said, I think we could go much longer, but maybe we'll have to do a part two at some point. But we're going to leave you with a few resources. We've got the name of Alicia's book, and as well as her company website. And we also have Todd's company website and a link to an important project for him called Fran Faith. We still have some time if either of you want to elaborate on any of this for the group.
Oh, I could jump in on the Fran Faith thing that you last mentioned there, Samantha.
Mhm.
Fran Faith is actually a community that we've started that we have 20 different co-founders, all very successful people in franchising. And the thought behind it is people of all faiths that you're all welcome, and we just make each other stronger. I think when we're in fact, it was interesting at our prayer breakfast that we just had at the IFA. Michael Side was one of the speakers, and Michael Side talked about the freedoms that we enjoy, and when we serve something bigger than ourselves, we achieve so much more together. And so that's true for the United States of America. It's true for franchising in general. We're serving something bigger than ourselves. And it's true for faith. And so it's a faith community. We have, over 500 members, and we have a generous donor who pays for our platforms. And there's lots of great content and podcasts and trips and different things. So just we encourage people to join the Fran Faith community.
Wonderful. I think that is an excellent point to end on. Todd, Alicia, you've been extremely helpful and knowledgeable. This has been an excellent hour for everybody listening. For everyone on the group who didn't hear this at the beginning, we'll send out this recording like we always do. Usually takes a day or so, so expect it probably before the weekend. And like I said, we do these every quarter, so look for them every couple months. And if there's anything that you didn't get answered, you can email us at loans@applepiecapital.com. You can reach out then, and we'll be happy to answer any questions that weren't answered. But I appreciate your time, both of you, and everybody for joining us. Thank you so much. Have a good afternoon.
Thank
Thank
you.
you.
Bye.